Do not be fooled by the Powell pump. Yes, the market rallied higher, and yes, there's a small shift in market structure, so we'll keep an open mind. But boy oh boy, if you ignore the strength of this next level, you're falling right into a trap. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame chart, and the first thing we should acknowledge is that, yeah, there was a rally today, but was there anything that changed in terms of the daily trend? And I'll pause here, literally think about it for a moment, and of course the answer is no. We have a green-bodied bar. Yes, we closed over the bottom end of the do-or-die zone, but where did we close relative to the top of the do-or-die zone? Certainly underneath. And when I mention that level in the introduction, I'm certainly talking about previous lows, also confluence with the daily 200 SMA, that could easily just provide a firm lower high on the daily time frame trend. You have to keep in mind that, of course, this is the highest high in the trend count. This is a lower high in the trend count, but I would even consider this a soft lower high. There was hardly an hourly uptrend in here to classify this as a firm lower high. I'd make the same argument with this over here, noting that we were still coming from the lowest low in the trend count. You could even consider this a soft lower high happening here, so happening here, and this would be a firm daily lower high because absolutely on the smaller time frames, we'll see this in just a moment, there's a structural shift. We certainly have lows. We have hourly higher lows happening here. We have highs, and now we sort of have equal / maybe slightly higher highs on the hourly time frame chart. But on the daily trend count, as long as we're underneath 573, I would not be making a compelling argument that, boy, oh boy, the bottom's in, and it's just going to be a blink of an eye before we're back at all-time highs. So on the daily time frame, you'll notice that today's bar, it looked over the Monday high, but it closed back inside of the Monday range. It's not the end of the world, and I would still primarily use the Friday low of now 2 weeks ago at this point, which is here at 564.65, roughly 566.15. As long as we're above that, the counter trend can persist. And if you recall from the Saturday update video, we had talked about this is totally a reasonable outcome within the possibilities of the market, right? You can easily set a daily firm lower high up against 573, set some sort of lower high back down here, and then we'll rotate back down to the equal low on the daily time frame, and nothing has changed from a trend point of view. So it leads to the question, where would we actually change our tone on the daily time frame chart in particular? Because as acknowledged in the introduction, the hourly chart is going through some structural shifts right now, but the daily certainly has not. So on the daily time frame, I would need to see consolidation here. Some sort of daily higher low starts to build out as being a little bit more meaningful. Some sort of hourly pullback to establish a mild hourly downtrend, establish the daily higher low. And then as I've been saying, I have not wavered one bit in this commitment over the last couple of analysis videos. I would need to see not only a higher low, but I would also need to see paired with it a higher high on the daily trend count. We would need to go on to breach 573 with improvements across all of the supporting evidence categories. And the reason that I maintain that stance is because we have not seen a capitulation style sell-off where the market's gapped down an additional, 20 points here in the ES or whatever. We're getting a little bit, we're exaggerating a little, but we've not seen a capitulation style flush where a V-shaped recovery would be the typical outcome that you're looking for after that. So a real structural low would have to be put in place on the SPY daily time frame chart with all components of a new uptrend, meaning firstly, of course, on the daily, a higher low, but not just a lower high and equal high still on the table. I would need to see the breach of that equal high for a higher high to confidently change my tone a bit more aggressively and say, okay, the daily is changing here. There's still the threat of a weekly lower high, really anywhere underneath this overhead supply. We'll take that in stride as and if it becomes a topic for conversation, but let's not get ahead of ourselves here. Let's just remember back to what happened today. There's a little bit of a pop on the Jerome Powell Q&A commentary, which I have my own doubts about, but we've closed back inside of the Monday range. The only thing going for buyers right now is the fact that sellers did not really materialize on that full rotation back down to the equal low here on the daily trend count, which of course is a consequence of the hourly time frame chart. If we just zoom in here for a moment, if we're thinking about the structural patterns we're mostly concerned with, we have successful breakouts, breakdowns, and then also failure patterns, right? We had a failure to go lower here. We call that a look below and fail. And great, the top end of the range always becomes the target. Now, on Tuesday, we started to initiate a look above and fail. Tuesday, all day, the consolidation was underneath the top end of this range, underneath the do or die zone. That's bearish acceptance. So in theory, the best outcome for sellers is to rotate to the bottom end of the range. Let's use an arrow here instead, something that would look like this. Of course, that didn't happen early in the session. Now, there was a great fade early in the day off of the do or die zone low, but as a consequence from Jerome Powell's Q&A, which again, as noted, I have my own reservations about, we'll get to that momentarily, you can see that we rallied through the top end of the balance range down here, and we've closed above. So it leads me to believe that early on in tomorrow's session, and even Friday as well, any consolidation over 564.65 leads me to have an open mind on the hourly trend count to say, okay, we have lows, maybe higher lows. We had highs, basically. This is a higher high. This is a slightly higher high. And so the hourly trend here is starting to flip in the upward direction. A structural hold outside of this balance range would be a structural shift. We did not see that on the first pullback here into Monday afternoon, and Tuesday speaks for itself with the bearish consolidation on the lows. So the shift is just starting to take place in the grand scheme of things. And we can't forget that the daily lower high is still possible underneath the daily 200 SMA and these previous lows from back over here at 573. So where does that leave us in terms of a pathing perspective? I think we want to be open-minded to the hourly chart holding this low as a higher low and rotating fully into the 573. Now, my base case, as we'll see through a number of supporting evidence charts, is that we're still thinking about a lower high being the primary outcome at 573. I'll be looking for some sort of double top. It could be a head and shoulders. It could be a simple hourly inverted hammer, something that looks like this. And here's the head and shoulders just for illustration's sake. Some sort of reversal pattern there is really enticing for at least a rotation back to the top end of the range. And then the ideal continuation would be some sort of Brigade bolt back into the range for that next rotation to the downside. This would keep markets bearish. It would keep the weekly trend down. It would keep the daily trend down. And the hourly trend would certainly be breaking back in the downward direction on this Brigade bolt underneath 564.65. Now, as acknowledged on the daily time frame chart, if we are going to have to make a stronger adjustment to our outlook here as we walk forward, the next thing that the buyers would want to see happen is, fine, you set this higher high up against the 573 on the hourly time frame chart, but please start to show me a daily higher low over the top end of the balance. If this starts to look like a daily higher low via some sort of hourly downtrend, and given volatility, it might not even have a chance to flip into an hourly downtrend. But a hold here, after rejecting 573, that once again, this is the key component, goes on to produce a higher high over 573, and maybe I'll be more constructive on a more structural bottom being in place in the market. Until that actually happens, what you see on screen right here, until that actually happens, I'm a little bit reserved in my expectations that everything's rosy and let's just start aiming for new all-time highs again. Now, of course, this brings up another consideration. What if the market just sees an opening drive to the upside over the daily 200 SMA? My first thought here is that I would love to actually see a failure for the market to go higher. I would like to take a short on some sort of rotation that looks like this. I think you sucker in a number of buyers here who start thinking, oh, look, everything's fine and dandy. Jerome Powell bailed out the market. The interesting part about this, of course, right, if we just go back and give ourselves a quick lesson in market history, this is Jerome Powell, right, back here. Is it possible that Jerome Powell marks the bottom of the market too? He marks the tops and the bottoms? Yet to be seen. But I would prefer to see some sort of big enthusiastic pop above this that then fails with a lower high back down underneath. And I think you have a clean opportunity for risk reward, something along these lines here, back down to the do or die zone low. Now, of course, we'll have to go through the same process of reevaluating what happens at 564.65. The ideal bearish continuation is some sort of Brigade bolt lower high underneath, or, right, some sort of hold here, and now we're back into that purgatory, sort of neutral. I will acknowledge that as trend traders, it's very difficult to be involved in the change of a trend. It's much easier as a trend trader to actually participate in the middle of a trend, right? Once we've established some sort of low and the market's cleanly trending back in the upward direction, great. Once we've established some sort of high and the market's cleanly trending in the downward direction, great. Those trades are much more lucrative for us trend traders. We always get a little bit, and I'm speaking for myself here, so if you're someone who's able to nail bottoms, nail tops, all the power to you. I hope you can retire rich, do whatever it is that you want to do, go into a bunker, turn the unlimited money printer on, keep nailing tops and bottoms, do your thing. But me, just a mere mortal, a trend trader, will never really have the best opportunities available as the market's in flux between different trends. And I think we saw a lot of this through the, February, late January stages as well. So that's certainly a consideration. Anyhow, getting back to the actual pathing of what's in front of us right here, right now, I think something that is interesting is checking in on our Fibonacci's from the last major leg lower all the way to the bottom. Just pointing out that technically, this is still a rejection. We have not closed a daily bar underneath the 38.2 from this point of view. If we do start getting above that, that's probably where we start changing our tone. That probably aligns with acceptance over the 573, as we were just noting prior. This would also suggest that if we are getting a hold here, it's maybe not the most bullish thing in the world, and it still could qualify as bear flag consolidation when viewing the market through this perspective right here. Let's come in from the lows, also up to this most recent high, just to get a sense for where this fib is and where the bulls might actually say, nope, this is kind of our battleground. It's not perfect, but it's mostly aligned with the bottom end of the do or die zone, close to that 564.65. So we'll carry that forward. Let's check in on the intraday anchored view apps as well and see what else we can glean. Oh, here I think it outlines the battle zone. The battle zone's really right here, and these will more promptly start to catch up because they're a little bit closer in terms of proximity and where their anchor points are. So as and if these start to catch up, I think it just reinforces this 564.65. If we're above that, it's kind of hard to be an aggressive short. I think that it makes sense up here at higher trade location. But if we're just consolidating near this area, if we're just holding in there on early Thursday, I would think firstly about the hourly trend remaining in the upward direction, trying to use that support, that confluence from the anchored view apps to maybe lift price into the 573. So once again, to sort of bridge the gap between the daily doubts of the lower high and the trend firmly remaining down, but then here on the hourly chart, right, the sellers unable to sort of rotate from a look above and fail to the bottom end of the range, the possibility of hourly higher lows here, this to this acting as an hourly higher high. We've got to sort of balance that hourly uptrend and daily downtrend that's still in force. So 573, 564.65, still absolutely paramount levels that the market is dealing with. Let's take a look at the market internals just to see if this can help us out with any sense of should we trust it, should we not trust it. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. The main thing I would like to point out here is that on today's session prior to the FOMC, we can write off the FOMC a little bit just because new money buyers typically aren't getting involved, right? There are a lot of algorithmic stuff on the FOMC day responding to every single word that comes out of Powell's mouth. Anyhow, prior to FOMC, you had a very balanced session, a little bit higher, a little bit lower, a little bit higher, a little bit lower, and the volume flows were technically up. So we'll give a little credit where credit is due. Not bad. The other thing we'll point out is that the Tuesday session was really much more of a liquidation break where it wasn't strong sustained selling through the session. You can see just very mild outflows from a volume point of view. So this starts to neutralize maybe the bearish take just a little bit and keeping us open-minded to the possibility of upside if, the key word here being if, we can stay over the top of the bottom end of the do or die zone. I know that's a mouthful, so I'm just referring to this. If we can stay over this level on neutral to bullish internals, I would have to stay open-minded in the near term for some sort of test of 573, right? Let's go back to the internals. What can we see out of the advanced decline line? We got towards trend higher zone, but not into it on today's session. What I really found most compelling, and if you're in the chat, the Discord chat, which is open, you can just go click the link down below in the description. That's fine. But one of the things, and we were even talking about this on X, you should follow us on X if you're not. One of the things I found most compelling about this morning session, especially this opening rally to the upside, if I just throw on the drawing set here, the market rallied pretty firmly into the previous day's high. This is Tuesday's high, and the market tick, the nicey tick, was not doing anything whatsoever. So that to me was a great rally to fade. It ended up playing out quite nicely on this pullback over here. But the point being is, as the market was accelerating in the upward direction, you weren't really seeing exchange level participation at the tick scale. Mild volume inflows. I think without the Fed, you probably would not have wound up at 300 million plus to the upside. You can see the trajectory here was certainly not on track versus, look at the slope of these arrows I'm drawing. Point being is that I'm not a believer outside of the Fed volatility that we saw into the afternoon that new money buyers were aggressively stepping up into this market. You can even see ahead of the Fed, there's actually quite a bit of sell-side activity hitting the tape here across the NYSE, not just isolated to some of the heavier hitting stocks. And the pure play example is just that Apple was almost entirely driving the move to the upside in the morning, maybe a little bit of Netflix combined in there as well. But here on this pullback, it's not like you just had a flat tick still. You actually did see quite a bit of depression out of the tick towards negative 1,000 versus on the rally, not even close to positive 1,000. So bottom line just being, I'm not a believer outside of Fed volatility that we had new money buyers stepping up ahead of the announcement. I think if we can continue to watch out for signs of new money buyers, we would want to see that happen under the premise of a constructive hourly trend staying in the upward direction, not rejecting for that 573 lower high. Let's jump on over to the market profile, see what else we can learn about the ES here. One of the things I find maybe helpful for the bull side of the market actually is just remembering this level. We talked about this on Saturday. It was the Thursday high of day being the value area low from Friday of last week. And on the Tuesday breakdown, that's kind of exactly the low that was found. And if you recall, we had said if these traders are going to be trapped as overhead supply, you probably want to see a value area low breakdown. You probably want to move back down into Thursday's range. So the fact that sellers were unable to really move beyond this level maybe supports the idea that in the short term, sellers are a little tired here, out of bullets, so to speak. We still have a poor low that's in need of repair on the Tuesday low, and we can clearly see that this is a B-shaped profile, which is long liquidation off of the open. So longs here, trapped from Monday, absolutely liquidated off the open, opening underneath the value area low. So pretty straight shot to the downside and all of the acceptance back in the range. For today's session, value is clean to the upside, but point of control didn't really migrate higher with price. You could maybe make the argument that if the point of control was really going to remain weak, it should have been here around 57.10. So a small move to the upside, small move to these three TPOs across, but generally speaking, great excess at the highs. It seems to me that this is the proper end of the auction there in L period, and on the pullback into the afternoon, one more time, not too much of a believer in what Jerome Powell had to say. Now, the technicals will always light the way. The price levels will always light the way. So if we just go back to the spiders chart, I want to be clear that I'm not just shorting this because I think Jerome Powell's full of BS. I'm shorting this when and if there's a lower high underneath the do or die zone low, and that to me seems reasonable. I think that the market's probably more sophisticated than just we'll take Powell at face value and everything's fine, right? So that's my take here on the S&P 500. Let's jump on over to the QQQ Cash ETF. Let's see what's going on from this point of view. Let's take a look at the NASDAQ side of the market. Any big changes out of the daily trend? The answer here is no. And you can actually see that relative to the Monday high, we've set a lower high. So there wasn't as much progress made on the NASDAQ side of the market, and we've just hardly, by a couple of ticks, closed over the top end of the balance range down here. We don't really have a do or die zone out of the NASDAQ, but I would certainly argue that a big lower high could still be found from the daily trend perspective up against 492.50, not 429, but 492.50. It's a big difference in those two numbers. And this lower high continues the overall daily downtrend that we're in. Once again, the logic behind this is we have not seen a capitulation style low. We have not seen this big gut-wrenching emotional washout, which would typically lead to a V-shaped recovery. This seems like much more of a systemic downtrend that's built out. So as we drop it so that takes care of the upside, right? This is our big lower high resistance that we want to be mindful of. There's absolutely the opportunity for counter trend to get there. I would look for Brigade Bolt higher lows over the Monday and now Wednesday highs. 484 would be your key level to get to 492.50, but then when we get there, promptly changing tone for the rotation back to the downside. Again, where do we change back to the bullish side of the market? Where are we a little bit more constructive about a firm low in place? Lows, higher lows, and show me the higher high. I know it might be late to the party, but that's fine. If we're believers that the bull market's going to continue for another 10 years, I'm not worried about missing this because the target's not the all-time high, it's past the all-time high, right? So I'd rather wait for confirmation than get in early and end up, losing on the million paper cuts trying to call a bottom without some sort of structure in place from a daily perspective. Now, of course, we'll have to combat the weekly opportunity for a lower high underneath the overhead supply still if this rallies to here. There's nothing saying that this can't be a weekly lower high, but we're projecting. This is way beyond the scope of what I would believe is possible into the end of this week. So with that, let's drop it down to the hourly time frame chart. We can start seeing the structure. Again, here's that balance range. Here's the look above and fail. In theory, stronger sellers should have rotated all the way to the bottom. That did not happen. And here's our close right at the level. It always makes our job a little bit more difficult than we would like when we've closed at a level. So we'll wait a little while to see if we end up opening above or opening below. If we open above, the first watch would be okay. We either support here, in which case that's where we look for something along these lines and probably more detail in that drawing requires this. Your entry is here, Brigade Bolt, high or low over these highs and this previous level. You can basically see the real anchor point is the Monday high, Monday open of last week's session. It's also the rejection of this Monday session here, today's upper wicks, of course. So 584 risk reward along those lines. And then here, like we talked about in the S&P 500, then you would flip it on its head and say risk reward back in the downward direction to retest the top end of the range, not just the breakout point here at 484. So those are the two primary ideas if the market moves to the upside. If the market just rallies immediately, I would say it's probably too difficult to capture the long in here. And there's some range, don't get me wrong. Quick Draw McGraw and Scalper McGee, they can do whatever they want to do in between this range. But the better structural trade would just be, and maybe this is just that Quick Draw McGraw, it's the high or low over the previous day's high. It's always a possibility. That's always a textbook sort of trade to take. But I would just be waiting patiently for this. I would think that that's the higher probability outcome given the considerations of the downtrend in the market currently. If we open above, and let's just say, because everybody always freaks out, oh, you're just saying that the market could go up, the market could go down. Well, first of all, the answer is yes. That's always the case. The market can go up, the market can go down, it can also go sideways. But if the market produces, we open above 480.25, and we just see a large red-bodied bar on the first, 5-minute bar, 15-minute bar, then from here, it should be quite clear what the outcomes we should be aiming for are. It's lower high in the range, rotate to the bottom. And now you just have another example of look above and fail. Look above and fail, and we'll trade the level accordingly. And this is pretty congruent with the bearish trend that we have on the daily time frame chart, the weekly time frame chart, and it would be a failure of this 1 hour attempted reversal, because we certainly have lows, higher lows, maybe higher lows could be perceived as being over 480.25. If we break that after just setting equal highs, not a higher high like what we have in the S&P 500, that's a trend reversal. Right? So 480.25 holds the key. 484 is pretty important there as well. If we open underneath, first thought, only thought is really looking for something along these lines, just totally trapped traders from the end of day spike during the Powell nonsense, which, as I've expressed now a couple of times, and this is my opinion, we'll wait for the technical triggers, but I think Jay Powell was a little bit of a liar to us for today's session in terms of putting on the bold-faced lie. Everything's it's all right out there, but it's not as good as it could be. And I don't think we're going for a recession, but the data doesn't look good. And anyways, we'll get to that when we get to it. There's the NASDAQ. Let's take a look at the intraday anchored VWAPs, supportive of the battle zone, I think, and we'll just use that term. We've also been using the hardball area in the S&P 500 for the morning shows. This 480.25, you're getting a lot of confluence with the VWAPs around that zone. If you reject this, that'd be a great rejection, but where's the actual entry? Probably here. Then rotating through all of this structure to the bottom at 470. If the market just sort of, rallies to get above this, then that would support the idea that this risk reward would be there. And then, of course, notice there's your anchored VWAP waiting, looming as resistance up at that 492.50. So great confluence with everything we've chatted about so far. Let's take a look. Oh, looks like the ES is back open for business, 6 o'clock on the clock. Perfect. Let's take a look at the NASDAQ market internals, see what's happening from this perspective. Volume inflows get substantial, over 400 million, but again, I would lean into the idea that prior to Jerome Powell, you didn't really see the trajectory that's there. You started to actually flatten out midday. So we'll take that with maybe a grain of salt. The advanced decline line had rolled back over to the zero line. It got closer to trend higher zone relative to the S&P 500. If we take a look at the cumulative build, all the same commentary basically, where the Powell volatility certainly caused things to get a little bit out of sorts, but even earlier in the session on this rally here in the NASDAQ, even in the NASDAQ specific side of the exchanges, you're not getting over 1,000 on the positive impressions out of the tick. You can see these upper wicks, not that you would apply technical analysis to these bars, but the point being is just that not a lot of time was actually spent. If you could drop this to like a 1 minute time frame chart and going out here to the open, right? It's these quick bars to the upside, then like back down. A little bit of a grind, then like right back down. Pop, and then right back down, right? So not a lot of time being spent up at these upper tick levels. It's not like you rallied, went sideways for 10 minutes, and then the bar closed low on a big flush to the downside. It's actually quite the opposite, right? So that's my take out of the NASDAQ, just not really being a believer here at the exchange level that you've got new money buyers really stepping up, ready to gas this thing back up to the all-time high. Let's get on over to the NQ market profile. And we'll rinse and repeat the conversation basically from the S&P 500, where here is your Thursday high, which is confluence with that last Friday's value area low. The compelling difference here is just that your value was underneath on Tuesday, and now it's back above on today's session. The point of control did not migrate slightly higher to that next ratcheted up point, so a little bit weaker out of the NASDAQ, which I think makes total sense given what we've already described in the first observation we made, just about the bar-to-bar lower high Wednesday relative to Monday. So if you're looking for a short, the NASDAQ might be the place to do it, noting where we've closed as well, just right at the top of the range, giving a little bit more leeway for an immediate failure into the range, whereas the S&P has a little bit of a chance to open above. You'd have to wait for that confirmation, whereas the NASDAQ might already be opening in range, depending on what we have for tomorrow's open. So that's the NASDAQ. Let's take a look at the most sensitive sort of not sector, but market index, if you will. We've got the Rusty Russell small caps, and the dividing line has been divided and conquered. We've closed above. We've also closed over the Monday range high, which I find kind of interesting here, given that small caps, again, are more sensitive to the economic data that comes from Jerome Powell, or at least the words he uses, and sort of the projections from the Fed. So walking forward, if this is going to be a stronger reversal, if this is going to help out the S&P 500 bull case moving higher, you've got the first steps there. You've got lows, and maybe you start to get higher lows over that 204. But as we've said in the S&P 500, and as we would all know from a inverted head and shoulders pattern, you really have to break the neckline. You have to bring in the higher high before we're feeling more confident. So the pieces of the puzzle are there. I can see the path forward. I don't think it's a stretch of the imagination to sort of think about, okay, if we're over this 209.25 level, that does start a daily trend reversal. The trouble with it is just that small caps have remained weak for such a long time that there's all of this overhead supply, there's this overhead supply, there's this. We could double that up into the good old balance range highs. These lows, which acted as a little support before the flush, you've got trouble with the weekly time frame charts, and we had talked about on Saturday, there's just a strong possibility for weekly lower highs here out of the small caps in particular. So counter trend until proven otherwise, even on the higher time frame like the weekly, I think the answer is yes. The weekly trend has been down here for far longer than what we're seeing in the S&P and the NASDAQ, which are just hardly slipping into downtrends on those higher time frame weekly. So I think we should be aware of that on the IWM and give some proper respect to something like 214 to still provide a rejection lower high. In the interim, I would say that this higher low consolidation over 204 probably just alleviates the pressure in the S&P 500 and at least makes it slightly easier. We've been talking about this concept quite a lot. Trading is not easy, but on a spectrum of difficult on the right and easier relative on the left, it probably alleviates the pressure and makes it easier for some of those counter trend longs to unfold, to at least test 573, if not maybe try to poke its head up above if small caps are staying over 204, threatening that neckline break in the upward direction. So that's my take on smalls. Down to the hourly, to get really small, you can see the inverted head and shoulders, fine, whatever, and just much more of an opportunity out of small caps to pull back and produce the higher low on the hourly chart. Whereas the S&P and the NASDAQ, they've closed right here. It's do or die off the open for them. Well, on small caps, you get a little bit more breathing room. If the market pulls back, it might not be the end of the world for small caps. You might actually see the market catch for a higher low at 204, in which case we're targeting this, 209.25. And once again, what does that do for the S&P 500? It allows for a little bit more of that optimistic take intraday, looking for the upside. So that's one thing I'm thinking about in terms of small caps playing its role, intermarket dynamics between the three big indices. We could take a look at the intraday anchored VWAPs. Nice high of day rejection, actually, but the cluster is going to be meeting us there for support around 204. I think you want to keep this one simple. If you're over 204, it allows some upside in the S&P. If you're under 204, sayonara. This is just a daily lower high, a weekly lower high, probably looking at the equal low, if not follow through to the downside. And given my perspective on Jerome Powell and what he told us today, although we just acknowledged from a technical perspective, yeah, there's some more leeway here to test the level, I feel as though this, and you never want to trade based on feeling, so I want to be very clear that we will be waiting patiently for the lower high underneath, but my inclination is that it wouldn't be shocking if we saw a pretty, normal breakdown underneath 204 and not just this blatant hold of the level looking for further upside across the market. So we shall see. I might be proven wrong, and I think I'll end the broad market commentary. Actually, let's finish up the Russell internals and the RTY futures market profile. Not substantial volume inflows over here. You are seeing a cumulative build that's still red out of the Rusty Russell. You are not in trend higher zone into the end of the session. Even during that midday pullback ahead of Jerome Powell, you had some pretty severe downside ticks here versus on the upside rally earlier in the session, nothing in over the 650-500 zones, just not there. So back to the market profile. Any differences to call out in this front? We can lean back into this Thursday. Thursday's high actually was not so substantial because it was not in alignment with the Friday value area low. And instead, I would just say, okay, here's the level. On Tuesday, you've got a massive poor low. I mean, ADEF period straight across the low, 4 TPOs wide. Not really what you want to see for the proper end of the auction, holding a higher low, propping markets up in the upward direction. So that could be the signal, right? If this poor low is going to get repaired, that could be the signal underneath 2060, opens the door for more downside relative to, of course, the IWM. That would just be our 204 right here. Sorry, not the 204, but rather Tuesday's low, the VWAP cluster. So you get here and then sayonara. That's probably your trade. You're really leaning into the ES shorts, the S&P 500 shorts, on a break underneath the Tuesday low of this week. So that's that. Now, what I was saying about finishing up the broad market on this note is I want to just take a second to remind everybody that I don't want to be any more bearish than I have to be. I don't want to generally bet against the U.S. economy. I don't want to bet against my long-term accounts. I think that we have to be realists, and the goal of any trader, right, is to make money. So that's why I'm sort of interpreting the data points the way I am. It still seems to me like the bears do have an edge in the short term, but I'm not just saying this because like, oh, it sounds so good to be bearish and oh, let's get dramatic and oh my God, the market's going to crash and burn and go to zero. I'm just not seeing the evidence of a stronger trend reversal across all the data points that we've explored so far. And that's really the gist of it. So with that, let's jump into our S&P sector performance, see if we're getting any rotations out of this. Leading the pack so far this week is energy, followed by financials, then industrials, materials, healthcare, real estate, and then it's the S&P index itself. There's only one sector here that really stands out to me, and that's the financials, because they are somewhat of a risk-on sector, up towards the top end of the list. But beyond that, and yes, I get it, everything's still green, and that's fine. Remember, correlation is one of the side effects of a very volatile market. It's like sell everything one day, buy everything the next day. There's nothing to rotate into. Oh my God, what do we do? It's everything. Up, down, up, down. You're just caught in the throes of volatility. But tech is sort of lower in the list. So is semiconductors. Communications, not really doing all that great. Now, I'll acknowledge that, of course, towards the very bottom, we have staples and utilities. Those are the most deeper defensive sectors we have in the lineup. But you're not seeing on this rebound rally in the upward direction huge outperformance from semiconductors or the tech sector. If this entire thing was led by the tech sector, if we got a close today at the daily 200 SMA with massive outperformance from the technology side of things, maybe we'd have a different take here, but that's not really what we have on the week thus far. We can filter by, of course, today's performance, and you're seeing things like energy still leading the pack here, followed by discretionary, financials still towards the top, industrials, maybe semiconductors got a little bit more love than we thought. Tech is on par with the S&P's performance. Not really enough to change the tone out of our ratio grid, which we'll see over here. We want to reset to this screen. Nothing. I know we're skipping around the order. We usually do this after the structural charts, but there's nothing that's suggesting relative outperformance from the risk-on sectors. Nothing happening here. A little bit of love out of financials, which I think was our first take on the weekly organization. This still looks like a pullback in the context of an overall new uptrend that's formed. So this is not really risk-on. It's risk-off, actually. And same thing with utilities over here, still looking risk-off to me. Let's check in on the structural charts. I think the key point that I want to make across the structural charts is simply that there's still room for all these lower highs. Energy's a nothing burger. It's been producing this sine wave for quite some time now. We'll let it do its thing. Financials, it's like right here, right now is a great spot for a lower high. If financials roll over, so let's zoom in a little on this. If financials roll over because the market doesn't end up buying Jerome Powell's bold-faced lie, I wouldn't be shocked. Like, this is a great spot for that. A retest of these two equal lows back here, this previous shelf of support, it acted as the neckline of this head and shoulders. If the market rolls over, let's not just ignore the fact that we have overhead supply weighing on price to the downside. Even if we go through, it's the same conversation point here. You'd need to see that much more structural. Okay, here's a clean higher low, here's your higher high. If we get something that looks like this, I'll change my tone here. right? That's kind of the way I'm approaching this. This is not a capitulation style bottom. It's actually a very poor low. It's mechanical in nature with all of these equal levels and also being so precise to the top end of this prior gap. Let's move along to industrials. Still a lower high happening here, so we're not out of the woods from a trend perspective. If we look at materials, a lightweight sector, overhead supply, great spot for a lower high. A little bit of relief on interest rates might be alleviating some of the pressure on materials, but not enough to change the trend. If we look at healthcare, pop back into this range here is a little bit more compelling, but this is a D for defensive sector. I'd say if this breaks over these highs again, and now we're starting to talk back about the inverted head and shoulders here, this trend reversal from a weekly perspective is probably a stronger story to talk about. But for now, in the midpoint of this range, it's not really helping or hurting. Let's be fair, right? It's not helping or hurting the case for the S&P 500. Moving along to real estate, even with rates coming down a little bit today, not much relative to their most recent range, real estate's unchanged, not much to really talk about here. New swing high, new swing low is really what we care about out of these lightweight sectors, and we're just not getting that. Here's the XLK. Obviously, it's going to look very similar to your QQQ. Huge overhead supply, nothing but still an opportunity for a lower high. I think if this holds as a higher low and we go on to produce some sort of break, maybe we'll be a bit more constructive, but I don't want to lose sight of the overhead supply. I also don't want to overstay my welcome on the bear side, and if it does become a more compelling bottom, we'll update you when that happens, but I'm still not seeing it here. Someone might make the argument for like inverted head and shoulders. I think it's a bit of a stretch. I would want to see the lows. I would want to see the higher lows, which we're starting to get, and then I'd show me the higher high. Show me the higher high. Show me that the trend is firmly flipped to up before we start doing anything more aggressive on the upside. For now, lower highs still loom. I think both of these upper wicks tell the story, where buyers are they're not confident up towards these highs. It seems to me that shorts are either squeezing a little bit, shorts late to the party down here dead on the lows are squeezing a little bit, or anybody who was long from up in this box is like, ooh, I can get out on a little bit of a counter trend rally. Let me get out of here real quick. Let me try to sell some of these highs. Take, cover, take profits, whatever. Maybe someone's long from, who knows? We're getting very speculative right now. That's not really the point of the show. But if you're long from down here, the August 5th panic, and you rode it to the highs, and now you're like, ooh, I don't want to give back all that gain. Let me start unloading some of it here. I think that's generally what's happening here. It seems more to me like either profit taking or mild short squeezes, not so much new money buyers getting involved. Semiconductors, same story. We won't bother you with the exact same walkthrough, but the point being is under 237. It's a tough thing to call on the bull side. I think you certainly have maybe inverted head and shoulders there, and there's the possibility for scalps and quick draw McGraw. Don't get me wrong. We'll always say that that's available. Traders, right? It's worth being nimble. But is this helping or hurting the case for the S&P 500? I would say unlike the XLV, which is a little bit more neutral inside of its range, this is certainly still a bearish data point. It's underneath the overhead supply with the opportunity for a lower high to be preserved underneath that 237. Moving along to communications on the lows, one more time, this is a balance range, you could say, possible for a counter trend, great lower high opportunity. There's nothing here that's changed the trend as of today's miraculous Jerome Powell rally, right? Let's move along to the TLT. Bonds, of course, catching a little bit of a bid here. In terms of relative performance, not quite outperforming the S&P today, but over the span of, oops, that's a funky zoom, over the span of this consolidation, certainly outperforming the market, so that is noteworthy, and it still looks like a flight to safety. XLY has been bludgeoned, of course, with Tesla just getting berated to the downside, so we'll see how that plays out. I think Amazon is maybe trying to play a helping role in the look below and fail, which we'll get to in just a moment. Some of these charts, I guess this is another comment, a little bit scatterbrained here this afternoon after the Jerome Powell live stream, but you got to be very selective in the charts that we're looking at here, and we'll show you which ones are which in just a moment, but it's like some charts are set up to see counter trends, some are not. Some are at lower high opportunities, some are at not lower high opportunities. Kind of a funky spread of the core list, but I think that's sort of being reflected here in the XLY, where it's still just consolidating on the lows, and it doesn't seem like there's any big reversal here. There's no hold at the daily 200. We're at sort of this inflection point. It looks to me more like a bear flag than anything else, not a structural low where any sort of break through these lows, you're talking about a thin structure retracement to continue the downward pressure into 187.75. If we build out some sort of break to the upside, then a higher low and a higher high, notice that's been the theme. You need all components of an uptrend. We'll start changing our tone here. You got to get constructive at some point for the trend to reverse back in the upward direction. You can't just be looking for lower highs at all times whenever you're not trading an all-time high. But I need, and as acknowledged earlier, as trend traders, I think we oftentimes are sometimes late to the beginning stages of the reversal, but for good reason. We're waiting for that added layer of confirmation, or at least I'll speak for myself. I am certainly. Let's take a look at the XLP. Overhead supply right at the level 80 is just over or under. I'm not particularly compelled one way or another out of this chart. It's a lightweight sector. It's also D for defensive, so it's not going to hurt if it rallies. I would say if it rallies and the S&P rallies, and this is the only thing to the upside, it's probably a short in the market, right? Generally speaking. Let's look at utilities. Not doing much inside of this range. If we break for a new higher high, that would be more compelling, but for now, just a little bit more neutral, not hurting or helping the case for the S&P. We already looked at these high-level sector ratios, so let's move into the risk-on, risk-off specialized ones. And the comments here are almost one and the same of everything we've said so far today. Is it possible that this is a counter trend? Yeah, of course it is, but what does that mean? Means that the overwhelming trend is still down. There is clearly an opportunity for a lower high across this, across this, across this, and this probably already could be considered some sort of lower high that's emerging if we get some rollover back to the lows. I would still acknowledge that a lower high could persist really anywhere underneath this prior element or up against the daily 50 SMA, the gold moving averages on your screen. So there's nothing here that's signaling risk on. There's nothing here that's signaling risk on. This is a bear flag underneath all of this overhead consolidation out of the ARK K ratioed to the S&P 500 itself. Nothing risk on here. Let's jump into the Dixie, the dollar. Pretty flat. These are weekly bars. So if you're thinking about this week as being that secondary, very small bar there, it's not really doing anything impressive. And I think that the market has digested basically. Let's quickly go to rates and then we'll go back to gold here. The market has sort of done the job of Jerome Powell reaffirming that 2 rate cuts, because that's what the SEP outlined. And we'll get to this stuff in a second here, the actual document. Jerome Powell reaffirmed 2 rate cuts. We know that the market was looking for 3 based on the Fed tracker tool. It's actually back to looking at 3, funny enough, on the heels of Powell saying that 2 is all we're going to get. So not shocked to see not much movement out of TNX rates and the dollar, obviously TNX rates being the same thing. Doesn't strike me as being surprising. This is like tariff volatility all through here, and now what we're dealing with is just the market digestion of that. So here's the pricing in. Jerome Powell acknowledges today some of the tariff stuff, and we'll talk about that in a moment. Markets didn't really do much beyond that. So the damage has already been done, so to speak, in terms of rates falling off of a cliff, along with the market moving lower also. Now let's get back to gold, because gold over here is remaining elevated near these highs, which to me is a sign that the market does not believe one word that Jerome Powell says about inflation being a non-issue, or the balance of risks falling more so away from inflation. I guess it's the same thing. It still seems like a flight to safety into the yellow metal hard asset versus equities. On a relative basis, yeah, it was down slightly today, but you would expect if inflation's defeated once and for all, everybody would just want to flock back into equities. And you didn't really see an aggressive downtick here for something that retraced back down to this breakout point. So to me, a little bit more of that defensive posture still shining through in commodities like gold. Let's take a look at inverted ZT. Small push to the downside here, signaling that rate cuts are still on the table. Jerome Powell sort of reinforced that. Let's get back on over to the Fed watch tool, and we can see that walking forward, the market's still expecting a pause in the next meeting, which is going to be bumped out to the month of May. There is no April meeting, of course. And then this to me is the funniest part. Prior to the Fed today, the market was pricing in 2 rate cuts, which is what the SEP outlined and accommodates. Now you can see it's 1, 2, and 3 before the end of the year. So the market's still calling Jerome Powell's bluff. And I think that this is sort of where we have this dangerous conversation about, can we take Jerome Powell's word in what he said today? He acknowledges, and we can actually, as we're doing this, look at the SEP. This is the summary of economic projections. What we really care about are these data points right here. He acknowledges that the soft data, the anecdotal data, the signals that people are seeing in remote spots across different economies and regions, really, from the Beige Book and the Fed, he's acknowledging that like some of the data in the sentiment surveys really aren't doing well, but the actual data itself, the hard data, you could say, we're talking about unemployment rate, PCE, it hasn't really gotten to a point of huge concern. So, okay, if the soft data is a non-issue and you're looking through some of the sentiment surveys, then why would you revise higher the unemployment rate? Why would you revise higher PCE on the non-core and the core? If you're thinking that it's a non-issue and this thing's in the bag and everything's all good, why revise this stuff higher? Why keep the Fed funds rate at 3.9% if you're like, well, the hard data is fine, so let's cut, it should be let's cut rates further. If everything's fine, then let's ease monetary policy because it's certainly restrictive as of right now. And, Jerome Powell says that himself. So the conversation here is just, he's talking a little bit out of both sides of his mouth. When is he not? You certainly have to give the guy some credit. He's got a very tough job. I mean, he knows darn well if he says the wrong things, if he says exactly what is maybe on his mind and what he's fearful of, markets are going to go to zero. Exaggeration, but you get the point. He's going to cause a market crash right then and there. So he's got to sort of play and toe the line a little bit, but based on the actual numbers in the SCP, and you can even go out here, right? Let's take a look at the dot plot. The dot plot's like almost signaling that it's 50-50, right? This is 9 data points in here, 9 participants versus 8 stacking above, expecting that we should have no or 1 rate cut in 2025, 9 stacked at the 2 rate cut sort of portion. It doesn't seem like there's a huge consensus at the Fed for, yeah, let's lower rates and let's bring things down so we can apply some relief and inflation's a non-issue. It seems like the Fed is very concerned about like, no, let's make sure that inflation is not going to rear its ugly head again. And I think the interesting conversation in the Q&A was that someone called Jerome Powell out and said, hey, you're saying that inflation is going to be transitory again. And Jerome Powell actually played this guy a little bit. There was sort of the call out like, what do you mean transitory again? Because if you think back to tariff talk in Trump's presidency the first time around, inflation was somewhat transitory. But of course, everybody was referencing, or at least the reporter was referencing, the sickness plunge and how the Fed was so late to getting that under control. So point being is, it seems as though the Fed is acutely aware of the inflation risks, but then you scroll down and you get even further. Let's get through the report to the projections of where they're talking about the weight of the risks. GDP growth risk is to the downside. Fed doesn't seem too concerned about slowing growth. It seems like they're definitely uncertain about GDP growth. But let's get down to this, which I think is most important to talk about. The risks to the unemployment rate rose substantially. The prior was broadly balanced with less risk weighted to the upside. And if we compare that with what's then happening in PCE, it also rose. But you'll notice that, of course, it was higher in the previous. The previous is the dotted line. That's the December SEP. So now it's like, okay, is the Fed more concerned about inflation or is the Fed more concerned about the labor market? We didn't really get a square answer from Jerome Powell through the Q&A. I think he sort of, again, to his own credit, he's got to walk a very fine line, but he spoke from both sides of his mouth, saying something like, I think if labor data, to quote him directly, I think he was saying that the national unemployment rate has not seen any major uptick. Yes, there are some regions that are suffering a little bit from slightly higher unemployment. Again, to get back to his quote, he's saying there's no issues yet in unemployment, but if there are issues, we're going to have to act really fast. We're going to have to jump on these things because it's kind of spiral out of control. And that's usually the case with how unemployment works anyways. So to me, it's just you can't have both. You can't have both because if you're going to combat an unemployment recession and lower rates to stimulate economic activity, while risks to inflation are still elevated because of potentially unknown uncertainties, and again, another thing to make note of from this particular Q&A, we've heard Jerome Powell say uncertain many more times than we've ever heard him say before. So I guess bottom line just is market rallied on this information, but I don't think it's substantial enough information that says we're out of the woods. To tie this back to the actual technicals, yeah, there was that pop over the key level, but I am not going to be surprised in the slightest if through the overnight we fade some of that rally, if we move back down into those ranges, if we set daily lower highs, 573 on that SPY, makes total sense to me given the tone of Jerome Powell through the press conference today, as well as these SCP updated projections. Moving along, the next thing we'll say here is, this is a little funky to read because of the way that the tool actually works, but the change in language in the statement is that there is uncertainty around, well, let's read it. Uncertainty around economic outlook has increased. I know this is really tough to read considering the way that the strike-through works, but again, uncertainty around the economic outlook has increased. The Fed's uncertain? Remember, they're not going to tell you when things are like bad. They'll probably tell you, okay, things are uncertain, but as soon as they start saying like, ooh, a recession could be here, we're very concerned about the labor market, the market's already too far gone at that point. So are these the early warning signs from the Fed that maybe be a little bit more cautious out there? It seems that way. I don't want to read into this more than we have to. And I think that the technical levels will light the way. But this was not a reaffirming Fed meeting where, okay, great, we're out of the woods. Let's rally the markets to new all-time highs. That's my take. I'm sure you could hear it through the technicals as well, leaking in a little bit, but that's my perspective on the Fed. That's always a little bit more subjective rather than objective when it comes to technical levels. That's the objective part. We're either over or under a level. This, of course, a little bit more of my opinion injected. So do with that what you will. Let's move along to the calendar. There's really not much to talk about. We have, of course, the jobless claims coming out tomorrow morning. That's pretty usual, typical for the Thursday morning, 8:30, then a pretty quiet end of the week. Not overly concerned with that. Let's move along to next week. Just pointing out that we have the GDP numbers, which have been a big question mark for markets as of late. Is it slowing down meaningfully, or is it really not going to be as bad as people project? Earnings calendar, nothing other than these three, and maybe Lennar on Thursday after the close. Micron for the semis, of course. Nike for consumer sentiment. FedEx always has good insights into both commercial and non-commercial shipping, and home builders, just getting a sense for if this alleviation in interest rates has been helpful at all or not. That is Thursday after the close. We'll keep an eye out for it. Let's get through the remainder of today's episode so I can go on my run. Just talking about that. Beautiful day here. And let's see what we got. Where are we? We're looking for the TLT ratio to the S&P 500. We've got ourselves nothing but sideways action. This, to me, like gold, basically, continues to suggest risk off. Not really feeling the love for equities currently. Moving along to bonds relative to themselves, the longer end of the curve getting a little bit more love here. Or what would you say? It's the shorter end is decreasing more rapidly than the longer end because both are sort of moving down slightly. Just to me means that the bond market itself is trying to do the job of Jerome Powell still. Not overly insightful in terms of inflation. Some small concerns, I suppose you would say. Credit spreads contracted meaningfully. I think this is one of the data points that the bulls would want to lean into here. The fact that credit spreads are coming back down. This is going to tie into volatility coming back down. It's something to be mindful of. It's a helping, supporting evidence data point, but until the trend actually changes down here, I would not use this as the only data point to say, okay, let's buy the market with both hands. It's got to go off to new all-time highs. It's not, this needs to be in conjunction with a trend change. So it helps, but it's not all the way there yet. Junk bonds drifting in the upward direction on today's Jerome Powell move. I think if anything, this is even a slightly risk-off consideration. If you go look at the dot-com bubble, if you go look at the great financial crisis, junk bonds will historically outperform equities even through a recession there, just being seen as slightly safer than the S&P equities. So not really a compelling bullish divergence, if you will. Let's move along to Bitcoin. It's still underneath its overhead supply. The Saylor Shift tool is still signaling a red sell signal, so nothing has changed here. There's still lower high opportunities. We'd really like a more structural low to be put in place at 71.5. We're just not there yet. Let's move along to the breadth of the market, which saw a subtle improvement. I'm not going to sit here and say it's like, oh, wow, look, new all-time highs. I think this aligns with similar take as credit spreads. Small uptick here, but still underneath the 50% mark. Same thing with new highs versus lows. A little bit of an uptick on the week, but still underneath the zero mark, which I don't think is anything to jump for joy about, especially when we're trying to spot a structural low. You want to see improvement out of breadth, right? Let's take a look at RSP is going to show us basically the same. One thing to maybe talk about is the recovery over the bottom end of this prior range, but it's the same thing where, okay, this is a step in the right direction. Maybe you have this, show me the higher high here, and that'll help the case for dragging the S&P higher. We're just not all the way there yet. Here's volatility falling off of a cliff back to the downside. Yes and no. What I think is interesting and worth talking about here is just the capitulation story that we've been talking about. You have not seen that yet. We've not seen a huge spike in vol up and over 40 where it's like, okay, this is the panic moment that we've been waiting for, and boom, it's over, right? You just haven't seen that. So the structural comments that we've been making about needing to see not only just a higher low, but also the higher high really stand true if we're not getting that capitulation spike. And you see the same thing here in the VVIX, where we're drifting underneath actually these prior lows, which is really interesting, actually, given everything that's going on. I would think with the quad witching on Friday, that would not be the case, but FOMC out of the way, volatility contracting. The one thing that continues to look not concerning, but stacks up on the, hey, remain cautious side, is vol futures are still in backwardation up here. You can see we're underneath the zero line. You can see that this, and this, by the way, also this needs to be adjusted. The roll to the next contract on VIX futures is underway, so that's probably gone, but we can just go over here. Let's go to the VIX futures, and if we take a look at this, Oh, it must have just renormalized on the 6 o'clock open, because if you go to the X account, our X account, Trade Brigade Co., the snapshot I took after the close today was still a mild inversion from April to May, but we're actually back in contango. It's not the smoothest looking contango. You typically want something that looks like this, but it steps in the right direction. So we'll watch to see if that uninverts and stays uninverted, or if on the quad witch, we get a little bit more volatility creeping back into the market. The one-day VIX, I think, is a signal. Remember that the one-day typically wants to make a spike and then come all the way back down to the lows. Make a spike, all the way back down to the lows. This has marked bottoms in the past. We have not seen that move all the way back down to the lows out of the one-day VIX. Just something to carry forward. Let's finish up today's episode so I can get on out the door here. And what do we have? NVIDIA. This is what I mean by some charts look good for counter trends, some don't. I think NVIDIA you could cut the cake both ways here. You could use this level as your over or under at 114.25, previous low here. If you're above it, maybe you're looking at a daily high or low. If you break underneath it, you're probably looking at an hourly head and shoulders, something that looks like that, and your neckline is here. So that's the push and pull out of NVIDIA right now. I would say that on the rally into the afternoon, the fact that we were unable to see a daily close over 118.25 kind of leads me to believe that more of the bear side could be coming in. And I can see the post-market, right? I see we're trading 118.37, so on and so forth. But the regular trading hours session into the afternoon, if this was going to remain constructive like the broad market, the ES or the S&P 500 for the counter trend to possibly unfold, you should have gotten a close over this level here for then this opportunity into tomorrow. Now, if we open above, maybe we still have that opportunity anyhow. But the daily bar closing underneath leaves a little bit to be desired. Depending on where we open tomorrow, I would be cautious through this range here. I would think if we open underneath, rallies to short up at 118.25 makes sense to me. If we poke through, I'd be a little bit more cautious of trying that on the first go around. I'd really want to see price out of these highs here for this kind of continuation through the thin structure off to the left up to 125.25, and we're just not there yet. So that's one step at a time. For the head and shoulders to play out, which we were noting on the daily, right? That requires, okay, you're not probably shorting this, although you have risk reward for that right shoulder. You're probably waiting and then saying, okay, Brigade Bolt closes the gap, thin structure retracement. We have a helper level at 110.85, and looking for follow through beyond that. So leaves a bit to be desired here out of NVIDIA. If you're using the higher time frames, I don't think you should lose sight of this, and that this could easily just be a lower high. And generally, as long as we're underneath the overhead supply at 129, there's nothing inherently attractive about this chart on the long side. And oh my God, we're going back to all-time highs. No, not if we're underneath 129. Let's move along to Microsoft. Maybe counter trend persists here. I think that we want to be mindful of the weekly structure and this box of balance above us, which is weighing on price to the downside. But then when you take a look at the hourly, for example, all day, not just the FOMC pullback, but all day, the market sort of held above this previous balance down here. So is it possible that you have lows, higher lows, you've recaptured the top end of the range, consolidation over 385 sends it back up towards these highs? That's a possibility. That's a possibility worth entertaining. So to me, this is where we have to pick and choose. I would definitely say for the remainder of this week, you need to be looking at S&P direction, or heck, even the NASDAQ direction. I usually use the S&P because, I don't know, maybe I'm not old. I'm not old. I promise I'm not old. The S&P seen as the old guys trading instrument. The NASDAQ is the nasty NASDAQ, right? Too fast for us old folks. But NASDAQ maybe a little bit more tech concentrated, of course. The NQ futures a little bit more volatile anyways. Point being, use the broad market index to help you select which opportunities you're going to read into. If the broad market's trading bullish, you probably want to find the more bullish setups that we talk about today. If the broad market's trading bearish, find the more bearish setups. So NVIDIA sort of falls into both categories. Microsoft to me falls into the bull category, where if we can hold this and rally, I think that a counter trend could be underway from the daily perspective to do something that looks like this, right? Get here and then we'll reevaluate for a lower high. Let's move along to Apple. Apple falls into the bull category on the short time frames. Let's go down to the hourly chart here. Bull category on the short time frames, but actually, I'm catching myself. No, it's the bear category. It's the bear category. The daily structure is an inverted hammer here, trying to break out of this range, inside bar range, right? Let's think about it from this perspective. There's your container. All of these bars are inside. I think it's good to maybe slow down and talk through this one together. So Inside bar ranges, look above and fail in the upper wick. I would actually be more interested in an Apple short underneath the low of the inverted hammer to rotate towards these lows, which to give you an idea are closer to 209. So call this a double top, call it whatever you want, but this Brigade bolt to the downside, probably a bit more compelling. And again, use the broad market to help you. If the broad market is trading short and bearish, this is a priority. If it's not and it's bullish, it might be a little harder to trade into this upper wick. And the reason I caught myself on this is because I sort of just like, mind was going faster than my mouth, but this intraday lower high I think is most compelling. Yeah, you have a higher high relative to the Monday session generally on the bar to bar count here to here, but look at the intraday, the opening rally that failed so aggressively all the way back to the opening print, and the Powell pop couldn't even produce an equal high. Seems to me that buyers are a little exhausted out of Apple. So one more time, this would probably be more along the lines of this if the broad market's moving lower. Hopefully that helps in terms of slowing down and trying to be a little bit more thorough in that analysis, not just speaking a million miles an hour and running with it. I want to give you the best information, not the fastest information. That's why these videos tend to get a little long. Anyways, Amazon. We were talking about this in the XLY. There's look below and fail here. This one I am confident about, right? Look below and fail on the daily time frame chart is clear as day. This lower wick from Tuesday breaches the lowest low of the balance range, closes in the range, and today we do get that pop in the upward direction. If we take it on down to the hourly time frame chart, we can see this really clearly, and we probably want to help our level here at, what is it, 193.85, let's say. Let's put a helper level on there. Let's do that. I would say consolidation here, Brigade bolt over 196, probably looking at the daily 200 SMA as a target, top end of the balance range. So one more time, if the broad market's bullish, this is a place to look. If the broad market's bearish, I would probably stay away from Amazon. Let's take a look at Google. This is a place to look. If the broad market's bearish, we're at the top end of the balance range. This is a great spot for a lower high. Looking for a lower high here. Reject prices, back down to the bottom end of the range. Sayonara. Right? So 166.35 on the daily time frame chart. If we were to breach over that, maybe there's a pinch, but based on the end of day, inverted hammers, larger upper wick stepping in near this resistance, first thought is if the broad market's bearish, this is a place to look for shorts because the risk reward, not to say that it's a no-brainer, but just to go back to the concept of trades existing on a spectrum, easier and more difficult, this is in alignment with the trend. It's check mark for easier. The risk reward is quite clear, check mark for easier. And if you have the proper structure, right, meaning that these hourly inverted hammers correlate with perhaps 5-minute reversal patterns tomorrow morning or some sort of rejection up here, great, another check mark for easier. So broad market's going lower, easier. Okay, so that's my take on Google. Looking for 166.35, moving along to Meta. Meta is one, we're going to flip the script a little bit, where I would say it can go either way, but I might lean a little bit more bullish on this. Why? Because we have the daily 200 SMA underneath us here. This is one of these names that has not breached the daily 200 yet, and if this is a double bottom, right, back into the range, look below and fail. If we're over 586, I would look for this rotation right here. In the post market, we are already over 586, right? 586.50 by 588. So a little bit more love for Meta through the post. If we can hold up over that, I would like to see this and view it through the lens of look below and fail, rotates towards the top. Now, of course, one step at a time. 607.25, 635.25 over time if we can continue this structure. Structure meaning consolidation, Brigade bolt holds above, then we look for the next level, right? If we just get consolidation, if this fails, if this does not hold 586, if we do something that looks like this, less interested. Moving along to Tesla. It's been beaten up, but I think it might be time to come back. We've got ourselves the possibility of a double bottom. Obviously, it requires patience until 254.50. If we're taking a look at this, we have a range. You have a look below and possible fail. And just like Meta, I would say, okay, we were looking for a hold over 233.50. Today was a great opportunity for sellers to potentially reject the gap fill reversal from the overhead range at the high of day early in the session. And I was watching for this trade. It didn't end up triggering cleanly, and good reason. Into the afternoon, we would not have wanted to be short there, holding a higher low even before the Powell volatility over 233.50. So not rejecting for a gap fill reversal leads me to believe that sellers maybe are out of bullets here. Don't forget, Tesla on the daily time frame chart is down, like 50% plus off the highs coming from here down to the lows of the move. 55% off the all-time high. I don't think, and let's see what happens over time, but I would think Tesla's not going to zero. We'll see. But for me, I'm starting to think about maybe the opportunity for a base to build out. We talked about the base ideally being over the weekly structure. That obviously did not take place. So now that the double bottom neckline is aligned with that weekly structure, I think that's the better opportunity to say, where is this? Where do we get this, and when can I change my tone back to the long side on Tesla? Moving along to JP Morgan, I think very similar to the XLF chart. There's not much to read into here other than the opportunity for a lower high up against 248. That would be concerning for continued downward pressure in the broad market. Then Netflix is a tricky one. The daily head and shoulders did not really result in that lower high, which there was a great trade on Tuesday underneath the Monday low for that to be expressed. But look at today's session, opening rally and then higher low prior to the Powell volatility into the afternoon over the daily neckline, over the daily 50 SMA. So I think this is actually pie in the sky, inverted head and shoulders, where over this helper level at 966.85, you could look for 999, the 1000 mark, which is the right shoulder. Right? If this does reject, I would not just be short willy-nilly underneath 950.25 because of this sort of thin structure in here. I would say let this consolidate, and then this is probably where we now have overhead supply. This is kiss it goodbye underneath 924. That's Netflix. I've got one trade idea for you. It's a familiar face. It is perhaps one of the most hated names in the market right now. Let's go to AMD. Let's take a look at AMD because you can get ready to hate it some more. Let's take a look at the trend channel that we are currently in, and we'll start from, let's just stay here, doing something like this and something like that. Where are we? Top end of the trend channel. Where are we in terms of trend? Certainly in a downtrend. Possibility for a lower high here. Horizontal level is tying in. You guys know me. I'm not always too fond of trend lines, so horizontal levels really rule them all. And 107.10 is right there. 107.10 is right there. We looked over the Monday high. Couldn't really see much acceptance above for a daily close. Closed back down underneath. Let's remove that trend channel actually and just take a look at the hourly. You can see these nasty upper wicks here. I think that there's opportunity for risk and reward to the downside. Some sort of rejection up here, whatever. Brigade bolt lower high. Risk, reward, interested in downside. 101.50 from 107.10. Please be respectful of this. Little helper level. It's the Tuesday highs. It's the Monday consolidation lows. It's the opening print-ish of today's session, 104. But generally, that is the concept. AMD is in a long-standing downtrend. Until that structure actually builds out, just like the broad market, right? Just like the broad market, until we produce higher low and higher high, then we'll get a little bit more interested. Maybe we'll change our tone a little bit more firmly, but for now, still in a downtrend, upper end of the trend channel, horizontal level tying in underneath the daily 50, no acceptance over that Monday high in the upper wicks. Continued rejection here offers great risk reward. It's worth a shot. That's what I've got for you in today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will see you tomorrow morning, bright and early, again for an episode of the Pre-Market Prep that kicks off at 8 o'clock Eastern, as it does every single morning. We'll see you up there in the office for another day of game planning and trading. And with that, I wish you a green trading week, and I will see you in the next one.